Luke Spajic, the EVP, Emerging Markets Portfolio Management at PIMCO, is joining us. Luke, good morning and thank you very much for joining us. Is that your reading too? Fed unlikely to move in 2015?
Well, very welcome and thank you very much for the invite. With September out the way, the focus has clearly shifted to December. However, it's very clear that the Fed is spending a lot of time focusing on overseas risk as opposed to domestic things. I'm sure the Fed really wants to get off the floor as soon as possible, but I think they are, as they say, data dependent, and they're watching the markets very, very carefully. And remember that the PIMCO view on rates is that the Fed isn't going to be able to hike anywhere near to the 3 or 4% levels they think they're going to get over the next few years. So I think it's going to be a very, very muted period of Fed activity going forward.
Okay, a muted period of Fed activity. Will it also prove to be a muted period for equities across the globe, Luke?
Well, I think equities, if people look back over the last 3, 4, 5 years, equities have had a tremendous run. And I think it's fair to say that expectations of equity performance like we've witnessed over the last 3, 4, 5 years is going to be very difficult to achieve. So we're not as we don't have a very, very high conviction call on equities from here. We certainly think there are going to be pockets of value in places like Europe and Japan because of QE mostly, but not really worldwide. And certainly the US is going to struggle, we think, a little bit going forward.
So the outflows that we are seeing from emerging market equities will continue, you think?
Yeah, I think what's important to note here when we're talking about outflows is that from a credit standpoint, investors bought emerging markets as an investment grade asset class. Now we're seeing this investment grade label being dropped, and some countries and some credits are moving towards high yield. Don't forget, this is not a labeling thing, this is a risk thing. So EM is now in transition. Securities are shifting from weak hands to strong hands. But most importantly, redemptions and outflows are not eliminations. The risk is still out there. They've just shifted to someone else's portfolio.
The global theme this year, Luke, has been slower growth, whether it's in China or even in markets like the US. Do you think that bad news has been factored into most global markets, or can we expect to see a further price correction in global markets?
Well, I think the most important signal we're going to get is this next quarterly earnings season, which kicks off this week. Clearly, everyone has started to revise down their growth numbers, and we saw official institutions coming out with lower numbers for 2016. When everyone starts to get to that low number, then maybe it's a good time to reevaluate what things might look like next year and see whether there can be any kind of new policy initiatives that might help. Certainly, we have seen investment expenditure and capital expenditure in the commodity world dropped significantly everywhere. We've seen a lot of very important emerging market countries like Russia and Brazil go into recession and they're facing very, very tough periods. And also we've seen the downdraft of what it means when China starts to slow down structurally. So yeah, it's getting to a point where I think everyone needs to look through this next earnings season and figure out how bad it's going to be for corporate profitability and what the companies are going to be doing over the next 6 to 12 months. But we're probably reaching a point where the growth numbers have hit pretty low levels. I mean, when the global economy starts to grow in the twos, it starts to feel a lot like a recession globally, although you won't necessarily see it in emerging markets.
Yes, it's the twos I wanted to ask you about. But before that, just one short-term question. This 48-hour rally we saw in across markets, will it have much legs?
I genuinely don't know the next 24 to 48 hours. I think if investors were very nervous before this move and were looking to lighten up positions, I think they should carry on doing that and clean up their portfolios and get into a position they're really happy with more longer term. I don't believe this is a significant turning point on a multi-year basis. I think it's just one of those liquidity-driven relief rallies.
Okay, well, to come back to the global growth point you were speaking about, something. We just got a report from Citi saying that the global growth this year, according to their estimate, is 2.9%. That's about the lowest. I think the international organizations are still sitting at 3 and 3.1. But what's your estimate of China, Luke? What is your own estimate of that country's growth this year and the next? And is that discounted?
Yeah, I think the question around Chinese growth is a tough one because clearly the official target of 7% is going to be very, very hard to reach this year and certainly will be a struggle next year. I think the consensus numbers are around about 6.5% for the growth rate. We're below that number. We may not even be in the sixes. Anywhere between 5.5% and 6% might be a good indication of where they are, other things being equal. So it just feels like a very, very low growth number given what's going on, but it's still a very impressive number nonetheless. So we're lower than consensus on the growth rate.
This 5.5 to 6 is for this year, 2015 or 16?
It's over a 12-month rolling period from here.
Okay.
Okay. Well, you know, actually, you're the second guest this morning who's told us that they're cautious on global equities. We were speaking with Rabobank a while back as well, and he too indicated that, you know, there's some caution as far as global equities are concerned. But by the way, our own markets too have now dipped almost into the red. Then Sensex and the Nifty has given back all of its gains, and the Bank Nifty is down almost about 0.5% or so. Luke, if global equities do not give you good returns this year, which is the asset class that could outperform from now, say, for the next 6 to 12 months?
Well, I think there has to be a big differentiation between whether investors are looking for growth or they're looking for income. I think there are lots of asset classes that offer income, investment grade, even some shorter dated high yield asset classes offer income, and even places in emerging markets offer good income, and for very, very long term plays, dividend plays in the equity market offer income. For capital gains, when you're having this kind of volatility and this kind of shakeout, it's going to take a while to pick out where the growth stocks are going to be. But obviously what we're looking at is when you see big reprices in things like emerging markets, and there have been multi-year repricings in emerging markets, I think emerging market equities for a long-term buy will start to look interesting. I think that's where there will be a lot of bottom fishing by investors.
Okay, that brings us directly to India. Is there a growth play? Is there I would assume a dividend play in the Indian bonds? How do you approach Indian assets?
Yeah, sure. So in terms of India, I mean, I feel most comfort talking about the macro side and the rate side. It's been a very aggressive rate cut of 50 basis points that we just witnessed, bigger than the 25 basis points that we were anticipating. Indian bonds remain attractive, although they've obviously they may not be as attractive as they were a year ago or 2 years ago. The cheaper oil price is helping the current account deficit, certainly. Modi is still seen favourably by the international investment community, though we are expecting a bit of an acceleration in the reform process, and you have a world-class governor at the central bank. So we think that Indian bonds are backed by very good fundamentals, and we also like the currency, given the current account concerns have dipped. It's very, very high carry. The only issue there is it is quite consensus. A lot of people like the Indian currency relative to the region. Now, on equities, I will make a big confession. I'm not an expert on Indian equities and don't have a high conviction view on Indian equities. But I think it has been a favoured asset class, and I think international investors will probably favour it over a lot of other local Asian equity markets. But I genuinely believe that when the beta situation stabilises and settles down, India needs to focus on the structural reform process, getting the credit market working properly, and there has to be a bigger belief that the policy framework is working to bring inflation expectations down. All of these things will help the equity market long term.
Yes, of course, but you know, he put out a forecast of I think 4.8% inflation by the last quarter of next financial year, I think early 2017. How much space do you see in terms of rate cuts?
Well, I think they're probably done for this year, and we're right now reviewing our forecast for next year. I think we've had a significant period of easing over the last 12 to 18 months, and again, if his real rate forecast of getting it down to that 2.5%, 3% range, then obviously there's still a lot more room on a multi-year basis to cut rates.
Okay. All right, Luke, we'll leave it at that. Thanks for joining us and giving us your view. That's the word coming in from PIMCO, second global expert today, telling us that global markets could be in for some amount of caution going ahead, and only some markets like Europe and maybe Japan look good, but otherwise most markets will see muted activity.